Hi, my name's Stephanie Doyle with Stephanie Doyle Investment Management. I'm going to be hosting the webinar today, Investment Planning Strategies for Coping with Market Volatility. I have been in this business for about 27 years, since 1993, and I've seen a lot of up and downs along the way of the stock market. So I'm going to share with you some things I've learned, mostly the good, and then tell you some things to hopefully try to learn from as well. With that being said, let's go ahead and get started. Oops, technical difficulty, sorry. There we go. Coping with market volatility. We're going to talk about 3 areas. Maintaining perspective. I think it's so important to actually look at what the market's done and how things have performed historically. That's no guarantee of future results, but it is nice to be able to see in the proper perspective what's happened in the past, to have a lens to look through going forward. Also, having a well thought out investment plan. I think this is probably one of the most important parts that we're going to go over today. Then we're also going to talk about using market volatility to your advantage, some ways that you can capitalize on what's happening. It's not fun when the market's down, but when you can actually look at it and use it to your advantage in some small ways, it can be very helpful. Maintaining perspective. Let's look at the stock market over the long term. Since 1926, small cap stocks have outperformed large cap stocks. You can see that the yellow line, the blue line is large company stocks. And then bonds are in the green, treasury bills in the blue, and inflation in the gray. Importance of this chart is to notice that stocks have gone up over time. Yeah, they've gone down. You can see some downward time frames, 1920s with small caps, 1930s. Some of them are very significant. Again, 1940s, end of the 60s, into the 70s, 80s, and along the way, we've seen quite a few downturns. Small company stocks have outperformed large company stocks to a great degree. I mean, we're looking at $7,000 for a dollar invested in large company and $36,000 for small company, but they have also suffered more significant losses when the market goes down. So they're quite a bit more volatile, and that's something important to keep in mind. Bonds, on the other hand, are a good bit more stable, and treasury bills, they don't pay that much, but they're very stable, and they historically have outperformed inflation. This chart here is called a Wallabory. I've seen charts like this that have gone back way farther. I didn't want to inundate people today for time's sake, but it's important to look that there's always something that the stock market's worried about. And this is from 2008 to 2019. And you see that the stock market has actually gone down quite a few times and recovered. 2008 was the biggest downturn, and that was the last structural down market, which I'll talk about a little bit in the next slide, when Lehman Brothers collapsed. Then you've had a lot of other things that have caused some more temporary, shorter-term downturns along the way, like the U.S. sovereign debt downgrade back in 2011 timeframe. We've got OPEC in here, Russia, Trump election, Greek referendum, all kinds of things. The most recent before coronavirus is the U.S.-China import tariffs. And we saw a big downturn at the end of 2018 from that. So from this chart, I would just take away that things happen, things spook the stock market goes down. Historically, it's recovered and gone back up. What about health crisis? Here are 7 of the last health crises that we've seen. And the stock market over the 6-month and 12-month performance of the S&P 500 after the end of the health crisis has been up in every case except for the measles, rubella in 2014. So these types of things have happened in the past. Have they been different than coronavirus, or should I say coronavirus? Has it been different than these other crises? Yes. These are event-driven crisis or other types of event-driven crisis, like say 9/11, where the stock market tends to have a V-shaped recovery and recovers pretty quickly. Does coronavirus have the ability to maybe move more into a structural down market because of the economic fallout? It's possible. Only time will really tell. It depends on how fast we can keep moving the economy going forward, how many people will actually be reemployed. We've seen a lot of people get their jobs back. They were just temporary. There's some fallout though that I see that could snowball into a little bit more of a structural down market, and there's really no way of knowing until we see how it all plays out and how fast we can actually keep getting things going and moving forward. And basically with the stock market, it basically is based on the growth. If a company is growing and making money and adding value to its shareholders, then it's going to continue to go up. And if it's not, then it's most likely going to go down. So whether or not these companies can continue operating and get back to uh, profitability levels that are above where we were, then we'll have to see how that plays out. But it's good news seeing that past health crises, things have recovered very quickly. Emotions. Emotions are the biggest problem when it comes to investing. When the stock market's up, everybody wants to talk about, oh, I did so good. I made this much money. They're so happy. Things are great. But when it's down, I mean, we saw the S&P from its high to its low, its peak in 2019, I'm sorry, 2020 to its low in March. We saw it down 34%. So no one liked looking at, and small company stocks were down even a good bit more than that. So no one wants to go bragging about how well they're doing at all in that situation. So I think what I want to put in perspective with this chart really is that when things are at the top is sometimes when you have the most risk, and when things are at the bottom is when there's the most opportunity. Selling at the top, taking some of your gains is great, and then buying when things are at the lowest is also great. But I mean, it's actually greater, but it's very difficult to do that and to time the market. And I'll go into that a little bit more in reasons why you shouldn't exactly try to time the market. But we're going to talk a little bit more structured along the way and how to develop a plan to not have to do that. So Warren Buffett says, he has a lot of famous quotes, but I think this is probably one of my favorite famous quotes, is be fearful when others are greedy and greedy when others are fearful. So how do you do that? Well, that leads me into our next section. Have a well thought out investment plan. I think this is probably the most important thing I've learned along the way. Investing is not speculating. It's not gambling. It is putting together a plan of action to help you meet what your goals are and your time frame and risk tolerance along the way. Some of the benefits of a plan: to be able to effectively manage the downside risk of investing, to provide a disciplined approach, and that takes the emotions out of the decision-making process. This chart shows what the stock market has returned. When I say the stock market, I probably should have said this earlier, but usually we're talking about the S&P 500, which is top 500 stocks. That's basically what we're talking about, the top 500 stocks out there, representative of the S&P 500. A lot of people look at the Dow, which is the top 30 stocks, and that's actually more closely watch, but the S&P 500 is more broad and a better example. And that's what most charts and firms and whatnot are referring to when they say stock market. So this shows the 1-year returns of the market each year from 1926 to 2018, 5-year annualized returns, and then the 15-year annualized returns. What you'll see here is that doesn't look like that much red. I mean, it's more than what you want, but when you actually put it into percentages, that is over 25% of the time that the stock market has been down. We just came out of a 13-year bull market cycle. It's easy to get lost in those bull market cycles and think that the market is just going to continue to go up year after year after year and you'll never see losses. But managing the downside risk of investing is probably as equally important, if not more important, for me and my firm and my clients than it is looking at the upside in returns. And we'll talk in the next slide about some of the reasons why, but I want to highlight some more things here at first. So 1 out of 4 years, the stock market is actually lost. And if you look at the 5-year annualized returns in the last 20 years, this is the dot-com bubble. I saw so many people who did not make good decisions, who were just riding on the technology bubble and lost so much, well over what the S&P 500 lost. And then the 2008 financial crisis. Again, so many people, these were not my clients, but people I dealt with back then. I was working with a lot of just self-directed individuals at Schwab, and they thought they knew it all. So it's important to know that there can be downsides in this, downturns in the market, and they can last for a while. Over, historically, 87% of the time, the market was actually positive over 5 years and down only 13% of the time. But you don't want to get caught up in those 13% and lose and have a hard time catching back up. Over 15-year returns, the market's been up 100% of the time. So why is it so important to not want to lose too much? Well, not only emotionally, that it really is so difficult to deal with, but if you think about it, if you had $1 million and you lost 50%, and we just talked about 2002 and 2008, 2000 to 2002 dot-com bubble, and then the 2008 financial crisis, the stock market lost 50% over those time frames from the peak to the high. And if you lost half of your money, if you had $1 million, you'd end up with $500,000. So to get back to where you needed to be would be $500,000. That's 100%. So if you lose 50%, you have to make 100% required gain to get back to break even. A lot of people think, oh, I lose 20, I gain 20, and next year I'm back to even. No, it does not work that way. The greater your gain, the greater your loss, the greater the gain required to recover. So back in the dot-com bubble, people who lost 70%, I saw people that lost more than that. They did not take my advice, trust me, but it was just sad to see people who are self-directed who actually, some of them may not have recovered. They may have not had the opportunity because that is just too great of a gain to have to recover from, to get back to where you started from. Now, what my firm does is focuses on managing the downside risk of investing. I mentioned that already, I believe. And if you can manage that downside and keep it lower, say 10, 20%, then your required gain to get back to where you started from is a lot less. It's kind of like a roller coaster ride. It's not as fun being on the kiddie coaster as it is being on, gosh, what was that one in Astroworld? Can't think of it right now. The big wooden one. Can't think of it, but it was a Texas Cyclone, I think. It was a lot more fun, but not when you're dealing with the stock market. So investment planning asset allocation. That is like one of the time-tested approaches that so many financial advisors use. It has been around for decades and decades. Investment planning, it's an investment planning strategy that combines different types of investments together in a portfolio based on an investor's goals, risk tolerance, and timeframes. It aims to balance the risk and reward of investing, to provide diversification, and to reduce the volatility. We'll look at 3 sample asset allocations. There's so many that you could put together, and these are just to give you a general idea. A conservative one, it would tend to focus more on preserving principal. Here you've got 50% bonds, 25% cash, and 25% stocks. It's important to note too that stocks are an important part of any asset allocation model, even if you are very conservative, because, and you can be more conservative than this one and not have as much stock, but it does help to offset and put a buffer on inflation and then add a little bit of growth in the portfolio as well. A moderate one tends to balance predictable income with potential growth. This is more of a 50-50 type mix. And an aggressive approach would be more focused on primarily on growth with more stocks. And it's important to look at here too. It's, having bonds in the portfolio, we saw them more stable, but a lot of times bonds will go up when stocks go down and vice versa. So having bonds in the portfolio can add a nice buffer to reduce some of the downside when there are down market cycles. These are 3 simple approaches. These are just sample allocations. Every allocation my firm puts together is customized based on the individual's goals, their time frame, their risk tolerance, and there's a lot of different types of investments that can be considered within these categories to go into there. There's all kinds of bonds, stocks, and cash, and then there's some cash alternatives as well, but we'll look at that a little bit more right here. So you've got, just on the bond category, you've got high grade bonds, and you can have short-term, intermediate, long-term, high yield bonds, which tend to act a little bit more like stocks. You get small caps, which you could break down into growth and value and blend, and large caps, again, growth, value, and blend. Where's my mouse? There it is. Then we've got an asset allocated portfolio, real estate investment trust, international stocks, and emerging markets. There's more categories. This doesn't cover all of them, but these are the major categories. This is the way that each of these have returned from 2005 all the way through 2019. Sometimes certain things are way at the top, and sometimes they're way at the bottom. Emerging markets is more volatile than these other type asset classes. Cash occasionally in down markets will be higher in the bonds, higher on the top performing, and then lower in up markets. And then you've got your asset allocated portfolio, which combines a varying degree of each of these types of investments together, and then rebalances each year or on a regular interval to get back to the original weightings and the recommended target allocation. This allocation is 15% large cap stocks, 15% international stocks, 10% small cap, 10% emerging markets, 10% REITs, and then 40% high grade bonds. So it's more along the lines of a moderate type portfolio than a conservative or an aggressive one. You can have any type of allocation based on what your situation is and any degree of these types of investments. But when you combine them together and then you rebalance them on a regular basis, then what it does is it helps minimize some of that downside. For example, in 2008, in the financial crisis, small cap stocks were actually down 33% and large cap 37%. Where an asset allocated portfolio, its worst performance was 22% in that time frame. So you're never going to get the top performance, but you're not going to get the worst, and it's going to be easier to recover from. and give you probably less trips to your cardiologist and all kinds of other doctors. So, how do you use market volatility to your advantage? Rebalance your portfolio, we talked about. I'll show you another chart to put that in a little bit more perspective. Dollar cost average, staying the course. This seems counterintuitive, but you'll understand in a minute. Take advantage of losses for tax purposes, and then learning from investment setbacks. Rebalancing your portfolio. It's simple. It just takes what you're supposed to be in based on what's your determined allocation, based on your risk, your time frame, and your goals. This particular case in period 1, there's 25% in each asset class. Over a period of time, the stock market going up and down, different asset classes going up, different asset classes going down, the portfolio tends to get out of balance. When it gets out of balance, simply what you do is you take some of what you made a little bit more on and buy into what you didn't, or what you may have lost on, to get back to the desired asset allocation mix. In this case, it's an equal weighted 25% in 4 different asset classes. It can be broken down into quite a few different asset classes, which I mentioned, and quite a, based again on your goals and time frame and risk tolerance. But rebalancing is very simple, it's systematic, and it's a way of actually selling what's gone up and buying what's gone down, or what hasn't gone up as much, which is a disciplined approach of buying low and selling high. Hence Warren Buffett's be fearful when people are greedy and greedy when people are fearful. Dollar cost averaging, what it does is it spreads out risk over time. Most people do this with their contributions to their retirement plans or their 401ks. Either say it's a 401k contribution out of every paycheck, or an annual contribution out of your, every year for your IRA. What dollar cost averaging does is it invests the same dollar amount at a regular interval over a period of time. You buy more shares when the price is low and fewer shares when the price is high. And the average cost of shares will be lower than the average market price per share during your investment time period. Say what? I didn't get that. Let's look at this chart over here to the right. So in this case, we had 10 shares bought here, 30 shares bought here, 15 shares, 20, 12 shares. Some cases the price was higher, lower, up and down. When you look at that, the average price here divided by 5 purchases is $20 per share. However, because of the market volatility and the fact of the dollar amount that was invested that was consistent, there was $1,500 invested total. It was $300 a time divided by 87 shares bought. That would be $17.24 is the investor's average cost per share. So dollar cost averaging works. Some other ways you could use it are as if you got an inheritance. Let's say you had maybe an investment property you sold and you want to put to work in the stock market. You got a bonus from work. There's a lot of different ways you can use dollar cost averaging, and you can avoid, especially in times like this when the market has been more volatile, in just putting everything in at one time and getting in at the absolute high and having the market drop soon after that. So you can spread your investments in over time. Could be over a matter of months. In this case, it was a matter of months. It could be over a matter of weeks, or however you want to do it. But it does work, and it's a great strategy to use, especially with new money coming into the market. Staying the course. It's like that makes no sense. But really, if you look at, Fidelity did a study on the best days of the stock market, and if you just missed out on being invested in those days, how much growth you would have suffered in not being able to capitalize on. So this is 10,000 invested in January of 1980 and just staying in all days. This person had $708,000 at the end of the time. If they had missed just the best 5 days, they would have had 458,000, and just the best 10 days of stock market returns, they would have had less than half of what they ended up with. So it's hard to time the market. I know people want to go in and go out and say, okay, this day, that day. It's very difficult to do for most people. Some people get lucky occasionally, but it is extremely difficult to do. And there is a lot to be learned from just kind of sticking to it. Now, that also has a lot to do with really where you are. I mean, if you are 100% stocks and you're 55 years old and you're wanting to retire in a few years, you shouldn't be 100% stocks. So that's something that we need to talk about and make sure that your allocation is set up to actually meet what your goals and your time frame are. So staying the course is important, but having a plan in action to actually ride through that course is equally important. So the other two things that that I mentioned earlier are taking advantage of losses for tax purposes. It's pretty self-explanatory. I mean, if the market's down and you've had some losses, you can take advantage of some of those losses to offset future gains. We have been in a 13-year bull market. There have been a lot of gains along the way and a lot of taxes paid on some of those gains. So if you have some losses, you can use those to offset any gains this year and then use some of them for tax carry forwards in future years. And then learn from your investment setbacks. Also learn from your, the successes you've had. And, history doesn't always repeat itself. This coronavirus is new. It's different. It's got its own animal, if you want to call it. No one knows how it's all going to play out. But what I do know is that these things we've talked about today, these strategies, the charts that I've showed you, it works. If you look at how the market's performed over the long run and you apply some of these time-tested strategies to what your situation is and what your goals and time frame are and risk tolerance, then you will be in a much better place than if you have not done that. So what does a financial professional do? Well, they do webinars. No, they help you determine your investment goals, timelines, and risk tolerance. You've heard me say that multiple times. That is so important. Create an asset allocation model for you. Select specific investments. And I think right now, I've talked a lot about asset allocation. I didn't really go into investment selection. And I think right now that is just as important as asset allocation. So you can have an asset allocation model that you could maybe tweak and go from more of a growth-oriented investment philosophy to a more of a value-oriented investment philosophy, more of a defensive investment philosophy. You can still be invested, but you can shift some of your focus to still maintain that asset allocation and reduce some of your risk going forward in situations like we're in now. And then the other thing that one of the many things that investment financials professionals do is manage, monitor, and modify your portfolio. That concludes the webinar. This is my contact information. I really want to thank you for taking the time out of your day to spend with me. Maybe next time it can be face-to-face. I do offer a complimentary consultation And I do some seminars in person live, but obviously with COVID-19 going on right now, this is the best way to help educate people and help hopefully keep them on track. I'd love the opportunity to talk to you if you have any questions, to just review your situation, where you are, and make sure that your portfolio is in line to meet what your needs are going forward and what your goals are. So take a jot that down if you want my information. It's investmentmgt.net is my website where you can get all that, or my phone number and email address are there. Stephanie E. Doyle, Investment Management. And we've got our disclaimer page, which is a great way to say, I hope you all have a great day, and thank you again for taking the time out of your day to spend time with us.